Good morning, student of CPA. This is your tutor CPA Lino Choi. It has been time since we did our last uh, session, that is in this platform of YouTube. So now I'm back. We'll be doing some of the live sessions in this platform. And at the same time, our online classes through the Zoom platform is still ongoing. So today, under this platform, I would like to look at financial reporting and analysis. Financial reporting and analysis, that is FR. I would like to look at financial reporting and analysis. And to be clear, I would like to look at one of the questions in a very common topic called consolidation. So we'll be talking about consolidation. So in this consolidation, I will be looking at one question that is for April 2025 sitting. April 2025. That is question number what? Questions number 3. Question 3. So I will be able to share the link. I will be able to share the link under the chat so that you will be able to access this question. Because on my case, I have it in a soft copy. So the question reads, on 1st January 2024, Pool Limited acquired an 80% controlling interest in Sharp when the retained earnings of Sharp Limited amounted to 3.2 million. The acquisition consideration consisted of an immediate cash payment of 12 million on 1st January 2024 and a further cash payment of 12.1 million deferred until 1st January 2026. Pool Limited has a cost of capital of 10%. We continue. No accounting entries have been made in respect of the deferred cash consideration. Pool Limited also acquired 50% of the equity interests in Choultry Limited and obtained joint control over that company on 1st January 2024. The purchase consideration comprised an immediate cash payment of 10 million on 1st January 2024. The retained earnings of Choultry Limited stood at 2.5 million on 1st January 2024. So I can interpret that one before we continue with the other additional information. So we can interpret that. So here, what they are saying is this. There's a company called Pool. It's acquiring two companies. So that is on 1st January, it acquired 80% of a company called Sharp Limited. Is this company called Sharp? 80%. So meaning that this one was acquired on 1st January 2024. So remember that a company, when it's acquired up to 80%, this qualifies to be what? Subsidiary. Because it rises between 51% to 100. It's between that percentage. There's a control. Then this company went ahead to acquire 50% interest in this company, Choultry, 50%. So when a company is acquired exactly up to 50%, this one is called a joint venture. This one is called a joint venture. And also this one is on 1st January 2024. So when these companies were being acquired, the payment, let's start with Sharp Limited. Let's talk about what we call purchase consideration. What we call a purchase consideration. So let's look at a purchase consideration. Because they said that in that paragraph 1, on 1st January 2024, Pool Limited acquired an 80% controlling interest in Sharp when the retained earnings of Sharp amounted to 3.2 million. The acquisition consideration consisted on cash payment of 12 million on 1st January 2024. So there was an immediate cash payment. There's an immediate cash payment of, that is 12 million. 12 million. And a further cash payment of 12.1 million deferred until 1st January 2026. Remember that this company was acquired on 1st January. Sharp was acquired on 1st January 2024. On this date, we paid 12 million as Pool. Then now, in the future, that is 1st January 2026, we are adding a further 12.1 million. We are adding this. We are adding that. So this is what we call a deferred consideration. So we can talk about deferred consideration. This deferred consideration must be discounted to the present. Discount. So that we know which is the current value. So we take the relevant amount times, in brackets, 1 plus r raised to n. From financial management. R is the rate. It's not about the cost of capital. And n is time. Remember, from 2024 to 2026, these are 2 years. So what I will come here and say is 12.1 million. So in brackets, 1 plus what? So the cost of capital, they said is 10%. Pool Limited has a cost of capital of 10%. So that is 0.1. Raised to 2. N is time, 2 years. The 2 years. So if we do that, so 1 plus 0.1, that is 1.1, raised to negative that one times 12. So that is 11 million. That is 11 million. So the total purchase consideration. So 12 plus 11. So it will be so is that one because if I take 1.1 raised to negative 2 times 12,100. It's a mistake I've done there. I need to rectify. So this one is 10, not 11. This one is 10. This is 10 million. So that we have 22 million. We have 22 million. We have 22 million. That is 22 million. So that is the purchase consideration. That is the amount Pool paid in the process of acquiring what? Sharp. So there was an immediate cash payment and a deferred consideration paid after 2 years. So you have to discount that. You have to discount that amount. So what about for the other one, the joint venture? That one was direct, I think, because the Pool Limited also acquired 50% of the equity interest in Poultry Limited and obtained joint control on 1st January 2024. The purchase consideration comprised a cash payment of 10 million. So there's nothing else there. We continue. So you have been provided with statement of financial position. Then there's an additional information. You can also interpret that. Number one, additional information number one. They are saying at the date of acquisition, the fair value of Sharp Limited's net assets approximated their carrying amount, with exceptions of some plants whose fair value was 1 million above the carrying amount. At this date, the plant had a remaining economic useful life of 5 years. Value adjustment was necessary. No fair value adjustment was necessary in respect to Poultry Limited. That is for the joint venture. But now for Sharp, we are told that the net assets approximated their carrying amount, with the exceptions of some plant whose fair value was 1 million above the carrying amount. So when there's a difference in carrying amount and fair value, when there's a difference in fair value and carrying amount, that difference is what we call revaluation or fair value uplift. So revaluation, that is revaluation when there's a difference. So there's a revaluation. So that 1,000 is a revaluation. It's a revaluation gain, or just we call it a fair value uplift. So remember that once an asset has been revalued, that revalued amount, since it's now in the adjustments to be done, it has not been subjected to depreciation. So we will go ahead and check for depreciation under charge. We'll go ahead and check for depreciation under charge. That is why they provided the remaining useful life of 5 years. Number two, Pool Limited measures goodwill and the non-controlling interest using the fair value method. The fair value of the non-controlling interest of Sharp was 5.7 as at the date of acquisition. So remember that as the parent, when you are computing for the goodwill of your subsidiary, you can either use full method or partial. You can only go for the full method when the non-controlling interest is measured at what? At fair value. If the non-controlling interest is measured at fair value. So that is why they provided the fair value of the non-controlling interest. So they said that Pool Limited measures goodwill and the non-controlling interest using the fair value method. So we'll do that. We will use full method when computing the goodwill of the subsidiary. Number three, during the year ended 31st December 2024, Sharp Limited sold goods to Pool for 4.5 million at markup on cost of 25%. 1/3 of these goods were still held by Pool as at 31st December 2024, and the balance payable was still what? Outstanding. So there's these goods which are sold from Sharp to Pool. When he was selling these goods, he sold at a profit. But looking in the books of Pool, by the end of the financial year, he has not resold all of them. So meaning that he has not realized the entire profit Sharp realized. So in consolidation, we need to avoid what call profit overstatement. So for us to do that, we need to check for the unrealized profit in the goods unsold in Pool, so that we eliminate it in the books of Sharp. We eliminate in the books of Sharp. But remember that amount was still outstanding. So that is an outstanding balance which must be written from our books. It has not yet been paid by the end of the year. So for us to write off an outstanding balance, we credit receivables and debit payables. Question number, that is additional information number 4. Impairment review performed on 31st December 2024 revealed that goodwill arising from the acquisition of Sharp had been impaired to the extent of 10%. So that is impairment. Once we do goodwill, we impair it by 10%. The interest in Cholt Limited was unimpaired. Calculate fair value of goodwill arising on acquisition of Sharp. So that is the first requirement. Requirement number, that is requirement A, goodwill. So goodwill, so that is the goodwill. Goodwill on acquisition of Sharp Limited. On acquisition of Sharp Limited. So we start with purchase consideration. We talk about purchase consideration. That is why we computed this. That is 22 million. Okay. So our statement is in thousands. So this one will be 22,000. Now, since we are using the fair value method, we add the fair value of non-controlling interest. We add fair value of non-controlling interest. So if we add that from note 2, it was 5,700. So that is 27,700. Then we raise net assets. The net assets as at acquisition. So net assets. So net assets, you go back to your equity. You go back to the statement of financial position. We have ordinary share capital. We have the ordinary share capital. So the ordinary share capital, this one is 20,000. Then share premium. This one I'm picking from the statement of financial position and equity. Share premium is 22,000. Then we have here retained earnings. But now for retained earnings, you need to begin on retained earnings. You pick the value as at acquisition date. As at acquisition. They provided that at the start of the question up there. There is somewhere they said that in the first paragraph, on 1st January 2024, Pool Limited acquired 80% controlling interest in Sharp when the retained earnings of Sharp Limited amounted to 3.2 million. Then also there is that fair value uplift, which is revaluation. It must appear here. That is from additional information number 1. Fair value uplift for the plant. So they are 1,000. So if you do that, you have your goodwill. The goodwill is so 27,700 minus 20,000 minus 2,000 minus 3.2 minus 1,000. So that is 1,500. 1,500. But remember, the goodwill of the subsidiary was impaired by 10%. Impairment, you are told is 10%. So 10% of 1,500 is 150. So 1,500 minus 150. So that is 13 what? 1,350. So that is net goodwill. We are done with A. We move to part B. We move to part B. So For part B, so they are saying for B. So for B, what they needed, we do is determine the value of interest in Chorley Limited as of 31st December 2024. So value of interest in Chorley Limited. So these are joint venture. So this one, you start with the initial cost of investment. So initial cost of investment, which is just the purchase consideration. So also at the start of the question, paragraph 3, they said Pool Limited also acquired 50% of equity interest in Chorley Limited and obtained joint control over Chorley Limited on 1st January 2024. The purchase consideration comprised an immediate cash payment of 10 million. So shillings in thousands. So that is 10,000. That is 10,000. So that is the initial cost of investment. Then you come here and add the share of post acquisition profit, share of post acquisition what? Share post acquisition profit. Post acquisition what? Profit. So remember that our financial year was ending on 31st December 2024. It starts on 1st January 2024. This company was acquired on 1st January 2024. When the retained earnings stood at 2.5. So paragraph 3, at the start of the question, somewhere up there, they said that the retained earnings of Chorley Limited stood at 2.5 million. But if you look at the retained earnings when we are closing our year, that is as per statement of financial position. As per the statement of financial position. So as per the statement of financial position, the retained earnings for this company is 3,800. So remember that this value is included here, is inside there. So to get the post, remember that I have said the share. So you take 50% of what? The post, you take 38, you deduct this 2,500 from that value. So about balance carried down, you deduct the balance brought down from the balance carried down to get the posts. To get the posts acquisition profits. So that is 650. So that is 10,650. So we are done with B. So before we continue with C, because C is a bit, it needs a bit of time, I can mention how you are supposed to get these 6 marks. Remember, this one was containing 6 marks. And here we have how many marks? And this one for the value of interest in Chorley, it's 2 marks. So they were marking this way. I can check how they marked these. So this was question number 3. This one was question number 3. So they were marking these and these. So anyway, they were marking these, and also this. So here they needed any 6. 1, 2, 3, 4, 5, 6, 7. So out of the 7, any 6, and each had 1 mark. Any 6 ticks. Any 6 ticks out of the 7. And even remember, this one is just 2. So you get your 6 plus 2. Already you have the 8 marks. Already you have your 8 marks. So guys, CPA guys, aspiring CPAs, you can see how we do our online work. So this one is for YouTube, but also we do the same under the Zoom platform. We do the same under the Zoom platform. So whereby right now, financial reporting is done on Wednesdays and Thursdays, 8 p.m. to 10 p.m. So in those classes, right now, I will have not gone direct to the question. For a class of consolidation, I will come in. I will introduce the topic in terms of theoretically, that is. So I will introduce the theory by explaining to you the key terms, what is a subsidiary, what's a joint venture, what's goodwill, how are these methods applicable. So once we are done with the introduction, which is done for one session, for a 2 hours session, that is, for a 2-hour session. So once we are done with the introduction, that is when now I will come in, do around 5 illustrations from the past papers. The same with published financial statements, the same with partnership, the same with branch accounting, the same with financial analysis, the same with accounting for the professional firms, and many more topics in that syllabus. So what you can do if you want to excel in the coming exams, that is the 2025 August exam, join my online classes. Join my online classes today. So we started our classes. So FR started just yesterday. Today we have another class because today is a Thursday. We have another class from 8 p.m. So you can use this number. So I can write somewhere. So that is plus 254 7, that is 28 760 5 volt 46. So that is my contact. So you can use this. So if you want to join, you contact me through this number. I will be able to tell you how much to pay. You will just pay around 4,500 to come in. We start classes. So let's continue and do what? The remaining part. Because once I start a question, I have to finish it. Once I start a question, I have to finish it. It's good to make it complete. So we do the part C. So part C, we say pool limited. So we say consolidated what? Consolidated statement of financial position. Consolidated statement of financial position asset. Well, 31st, it was December 2024. So we say shillings in what? Thousands. So you know that we start with non-current assets. We start with the non-current assets. We can do it very fast. So we start with property, plant, and equipment. I can shorten it to this one. Property, plant, and equipment. It's all about parent plus subsidiaries. So you add parent plus subsidiary, then you do relevant adjustments. So it's all about 3,036,400 plus 18,500 So under this, if there was revaluation, we add, there was revaluation, the fair value uplift. Then we do what? We minus depreciation under charge. We minus depreciation under charge. And got some workings here. So remember that for depreciation under charge, it's just taking the 1,000, which is the fair value uplift, divided by 5. So that is what? That is 200. That is the 200. There's no another adjustment for this question. But if there's the rights of unrealized profit on fixed assets and the depreciation overcharge, you adjust. There's other questions I've done whereby we have the aspect of UPFA, unrealized profit on fixed assets, which leads to depreciation overcharge. So the next item is investment in Sharp. Investment in Sharp is replaced by goodwill. Goodwill, that is for Sharp. I remember it was 13 what? 1350. Then for investments in investment in poultry, we know it was around what? The one we have just computed some few minutes ago, it was 10,650. This one is from part A, that is from part A. This is from part C, part B of the question. And after that, we go to what? Current assets. Move to the current assets. So for the current assets, we have inventory. Inventory, parent plus subsidiary, 21,400 plus 13,000. Here, you are supposed to deduct UPS. Remember that there's some goods which were sold from Sharp to goods sold from Sharp to Pool. These goods were sold at 4.5. 25% on cost. But Pool, at the end of the year, he never sold a third. So we need to check the unrealized profit on stock. We call it UPS, which is the unsold goods times profit margin. Remember that 25% on cost, that is markup. That is the same as 25% of 100. If we reduce this, if we just say that this can be same as a quarter, so this is a quarter. But now for us to change it to margin, you add the numerator to the denominator, So you get 1/5, a fifth. And a fifth. So 4,500 divided by 15. That is 300. So that is what you deduct here. So we can be saying you can say the 36,400 plus 18,500 plus 1,000 minus 200. So the first one is 55,700. This one. Then 21,400 plus 13,000 minus 300. That is 34,100. Then we continue to other areas like trade receivables. So trade receivables, that is 18,500 plus 11,400. But remember this amount, what they said, under additional information number 3. And they said that, let me just read the entire note 3. During the year ended 31st December 2024, Sharp Limited sold goods to Pool for 4.5 at a markup on cost of 25%. 1/3 of these goods were still held by pool as at 31st December 2024. And the balance payable was still outstanding. So this 4,500 was still outstanding. Outstanding. That is by the end of the year. This amount has not been paid. So it's outstanding by the end of the year. So the outstanding balances are not supposed to be carried forward to the next financial year. You cancel it out in the current financial year. You credit receivable and debit payable. Credit receivable, debit what? Payables. Payable account. Receivable account, payable account. So remember, it's trade receivable account, trade payable account. So here you minus crediting. This one is deducting 18,500 plus 11,400 minus 4,500. So this is 25,400. Then you go to cash and what? Cash and cash equivalent. So for the cash and cash equivalent, talk about 12,700 plus 8,100. 12,700 minus, that is plus 8,100. Parent plus subsidiary. So you get 20,800. So up to this point, we have total assets. So 55,700 plus 13,50 plus 10,650 plus 34,100 plus 25,400 plus 2,800. So that is, and we'll be able to add later and confirm with our equities and liabilities. For now, let's continue with equity and liabilities. Because the balancing figure is not marked, but we have to balance it. For now, we have to balance it. It has to balance. There's no option. It has to balance. So we start with equity. So for equity, we talk about ordinary share capital. We talk about the ordinary share capital. So the ordinary share capital is 50,000. Then share premium for the share premium, we just pick for the parent only. Remember this one I picked for the parent. The value of the parent, that is pool. And also this one you pick for the parent. So for the parent is 5,000. That is 5,000. That is 5,000. Then now next I will be able to do the retained earnings, because the next item is retained earnings. I can clear this other side. So next is all about retained earnings. But this one now needs a working. This one needs a wide working. This needs a wider working. So instead of going to do a working, and it will only have one mark, first do the others, because they are easier. There's other entries which you don't have to go and do a separate working. So for this one, just reverse space. Continue with what? With the others before you embark on doing the retained earnings. So up to this point, remember that up to this point, after taking ordinary share capital, share premium, and adding with the retained earnings, what we get there is equity attributable to group owners. Equity attributable to group owners. The next, I'm just consolidating this statement the way it is. So before I go to non-current liabilities, we have to introduce what we call non-controlling interest. Non-controlling interest. Also here we are trying to check the capital attributable to the minority shareholder, because we were not controlling the subsidiary 100%. Remember, it was an 80% controlled subsidiary. So we have to check the capital of the minority shareholders. So that is why now up to this point we have what? Total equity. So even this one needs a working. I will be able to do it later. So we have this working and this to be done. But it's better we finish with the likes of long-term borrowings, because it's just adding parent plus subsidiaries. Trade payables is just adding parent plus subsidiaries. Then we adjust with the outstanding amounts. Then for current, so we say non-current liabilities. So for the non-current liabilities, we have long-term borrowings. Long-term borrowings. So for the long-term borrowings, it's just adding 18,000 plus 8,500. 18,000 plus 8,500. So that is 26,500. Then current liabilities, for the current liabilities, we have trade payables. Trade payables. So trade payables is 16,300 plus 95. But I said for us to eliminate this outstanding amount, we credit receivable, receivable, we debit payable. Debiting payable is also deducted. So 16,300 plus 9,500 minus 45. So that is 21,300. And after that, we have current tax. We have the current tax, which is direct, 8,500 plus what? 49. 8,500 plus 4,900. So that is 13,400. But there's something they talked about concerning deferred consideration. Remember that when they were paying for the acquisition of Sharp, there was a deferred cash payment, which we discounted, which has not been done. What? No accounting entries have been made in respect of the deferred cash consideration. So that one must appear here as a liability. The deferred consideration has not been recorded. So it was 10,000 plus that interest of 10% times. Remember that the cost of capital was 10% times the relevant 10,000. So that one will be there, 11. That one will be there, 11. So this is all about total what? Equity and liabilities. In your exam, even if you do this way and leave this and this, you will have all the marks. Because it's 12 marks. When this was being marked, yes, they needed 12 entries. Let's see if you have 12 entries so far. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You already have 12. Even if it was just one tick, 1 mark. Already you have the 12 entries, because there are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You have 12. And so we can do the relevant working. So we can start with the retained earnings. We can start with the retained earnings. But now for us to do the retained earnings, so we just do a working. So for us to do the retained earnings, that is the profit. That is the relevant profit the parent was getting from both companies. The profit, the retained profit, the profit they retained from Sharp and Choletry. So what we do first, let's get the net assets. Let's do the net assets in what? In Sharp. Net assets in Sharp. We look at net assets in Sharp. So net assets in Sharp, based on what? Asset acquisition date. So acquisition date. So we look at acquisition date, reporting date, so the reporting date, and the post-acquisition change. I just say ASQ, post-acquisition change. ASQ, post-acquisition change. Due to space, due to the space. So, remember, the first one is share capital. But we only have all the other net assets remains constant. Even if it's acquisition date, reporting date, the net assets they remain constant, other than the retained earnings which changes. The part only we have changes is the for retained earnings. Then we do the relevant adjustment. So remember that anyway, check your share capital. So share capital is 20,000. So meaning here you have 20,000. And there is 20,000. So there's no change. There's no change. The same with share premium. Share premium is 2. So it's 2K. So meaning here is 2. We don't have a change for this. So the only part where we have a change is under retained earnings. So retained earnings is retained earnings, acquisition date. If you can check at the start of the question, we were told that the retained earnings as at acquisition date was 32. Was 3.2. Then a reporting date, remember, is the one in the statement of financial position. The one in the statement of financial position is 6,100. So you can see there's a change. So the change is 29. Then also there was revaluation, which we call it fair value uplift. There was fair value uplift. So the fair value uplift was 1,000. But you add that. You have to add. So there's no change for this. Then now you do the relevant adjustments. What will affect your profit? What will affect your profit? Remember there was depreciation, depreciation under charge. And there was the rights of UPS in that question. There was those depreciation. So res depreciation. So we say res. But now we res post-acquisition depreciation. Post-acquisition depreciation. Post-acquisition what? Depreciation. But depreciation was? It was 1,000 divided by 5. It was 200. It was 200. It reduces our profit. You have to reduce it. And you credit. Then also I've said there was UPS. Remember there was UPS. UPS, unrealized profit on stock. Our UPS was 300, and here is profit. Remember, to avoid profit overstatement, I said that UPS must be eliminated. That profit must be eliminated there. So you eliminate. So once you do that, you have the fair values of the net asset. Fair values of net asset. So the fair values of net assets. So here, and here. So that is 22,000 plus 2,000 plus 3,200 plus 1,000. So this one is this one will be 26,200. That one is 26,200. Then the other one is 22 plus 61 plus 1,000 minus 200 minus 300. So this one is 28,600. Then 2,900 minus 200 minus 300. So this one is 24. So we can continue this side. I can clear this a bit of the work here can be cleared. So now you go ahead. Remember, these are working. So now group retained earnings will be our group retained earnings will be. So you start with the parent itself. So pool. So from the statement of financial position, pool remitted. The retained earnings of pool, that is the parent itself, is the retained earnings of the parent is 13,200. 13,200. Then now you take that of shape limited. So remember that the parent was controlling this 80% times what? This 2,400, the post acquisition. So 0.8 times 2,400. So this is 1920. Then now next, you talk about Choltree, what he was taking from Choltree Limited. So you take also the post, which is 50% of. Remember that we said balance carry down of 3,800 minus 25. You remember when we were doing the value of Choltree? That is part P of the question. The post acquisition profit. Balance carry down minus balance. The balance brought down is deducted from the balance carry down. So 3,800 minus 2,500 times 50%. It was 650. It was 650. Then there's some adjustments here to be done. You deduct things like the ungood discount. The ungood discount on deferred consideration. The ungood discount on deferred what? Deferred consideration. The one we added here. So the 10% of that amount. So it was what? 1,000. Then finally, you raise what? Share of goodwill impaired. That's to reduce your retained earnings. Share of goodwill impaired. Share of goodwill impaired. Because already for the likes of depreciation and the UPS, already we have deducted that. So the only thing we have not adjusted is this and this. Share of goodwill impaired or impairment. Impairment, remember it was 150. So 80% of 150. So 80% of 150, that is 0.8 times 150. That is 120. So 13,200 plus 1920 plus 650 minus 1,000 minus 120. So I'm getting 14,650. 14,650. 14 what? 14,650. That is what you will fix here. So 50,000, 55,000 plus 5,000. That is plus, not plus. 55,000 plus 14,650. That is 69,650. Hi. Non-controlling interest is not even a must. I do a lot of workings because for this one it was simpler. I can use this space. I can use this space. I just stop saying total equity. I use this space. So non-controlling interest, how can you be able to get it? The non-controlling interest, what is attributable to the minority shareholders? So what will be attributable to the minority shareholders will be done this way. So I'm trying to clear something here. So it will be done something this way. So if you look at your question, well, you were given the fair value of the non-controlling interest. That is additional information number 2. There was a fair value of the non-controlling interest given, which is 5,700. The fair value of the non-controlling interest is that one. The fair value of the non-controlling interest, that is given from note 2. So you will be able to add. What the parent is getting from Sharp, from this post-acquisition profit of 2,400. So you will get, remember that the parent was controlling Sharp up to 80%. So from this, it will take 20%. So add 20% of 2,400. So after that, you will be able to do what? To check any adjustments to be done. Which adjustments can you do? It was not done. Any adjustment, share of the goodwill impairment. But remember now, you don't use 80%. You use 20%. 20%. 20% of what? 20% of the 150. And we will be done with that. Remember that it's the fair value of the non-controlling interest. Then now, remember that the non-controlling interest is here in Sharp. That is where the parent acquired up to 80%. So the 20 is the one which is the minority shareholders. Those are the minority shareholders. Then you do what? You adjust with your impairment. So that is 61 what? 6150. So in short, our total equity could have been the total equity plus 69,650. So that one will be 75,800. So total equity 75,800. 75,800. So if we continue adding so that we have total equity and liabilities plus 26,500 plus 21,300 plus 13,400 plus 11. So you get 148,000. Equity and liabilities 148,000. What about this? 55. That is for the assets. of the assets. Remember that this one was non-current assets. So we started with the assets. So which we talk about non-current assets. Then we have the current assets. So total assets, in short. So 55,700 plus 1350 plus 10, 650 plus 34, 100 plus 25, 400 plus 2,800. So that is 148,000. So I said for this scenario, it has to balance, and it has balanced. So they were marking just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. They don't mark totals. So out of the 14, they needed any 12. Any 12 times 1, you get your 12 marks. Any 12. So, and that is how you were supposed to do this question from financial reporting and analysis. Financial reporting and analysis, April 2025 sitting. Question number 3. So, guys, I said earlier that we also do what? Online classes through the Zoom platform, where I have many students in that platform. So we always introduce a topic, then we do illustrations from the past papers. Each topic. So we started classes. FR is done on Wednesdays and Thursdays, 8 p.m. to 10 p.m. So you can join. So you can call me, and I will be able to give you a direction on how. My contact is 28 760 546. But remember, for the guys who are outside, like now I have students from Cameroon and Rwanda. You say plus 254 plus 254. So you can contact me through this. You can be able to reach out. You can WhatsApp. It's not a must you call. You can WhatsApp me. I will be able to give you more information on how to join the online classes. So let's meet in the Zoom platform, where we do a lot of work, where we do exclusive work which can help you to sit for the August exams. Thank you, and welcome. And never forget to subscribe to this channel. Already we are at 13,000 subscribers. And by the end of this year, we hope that we will be at 20,000. So also subscribe and share these videos to your friends. Thank you once more, and welcome.